I'm going to tell you something that sounds impossible. The more you try to be consistent in trading, the less consistent you'll become. I know, it makes no sense. You think discipline means showing up every day, taking trades, staying active. That's exactly backwards. Real consistency looks like laziness to the untrained eye. It looks like I'm doing nothing for weeks while you're busy making trades. But here's the truth they don't teach you. Consistency isn't about how often you trade, it's about how often you don't. And until you solve that paradox, until you understand why doing less creates more, you'll stay trapped in the cycle you're in right now. Listen to me carefully. You're not failing at consistency because you lack discipline. You're failing because you've been taught a lie about what consistency actually means. Every trading course, every guru, every book tells you the same story. Be consistent with your strategy, follow your plan, execute your setups. They're teaching you to be consistent with the action of trading. That's the trap. That's why you feel like you're doing everything right and still bleeding money. I'm going to show you something different. Something I learned after making and losing four fortunes. Consistency in trading isn't about what you do when you're in the market. It's about who you are when you're out of it. It's not a behavior problem. It's an identity problem. You're exhausted from fighting yourself. Every day you promise you'll stick to your rules, and every day you break them. You watch yourself take trades you know you shouldn't. Exit winners too early, hold losers too long. You feel split in two. The trader you want to be versus the trader you actually are when money's on the line. That gap is eating you alive. Here's what changes everything. You're trying to be consistent with a self that doesn't exist yet. You're trying to execute like a professional while still thinking like a gambler. You can't discipline your way. Out of this, you have to become someone different first. The market doesn't reward consistent behavior. It rewards consistent thinking. Get your mind right, and the behavior follows automatically. Get the behavior right while your mind's still wrong, and you'll just find new ways to lose. I'm not going to give you another trading system. I'm not going to tell you to meditate or journal or follow a checklist. Those things are fine, but they're treating symptoms. I'm going to show you the actual structure of consistency, what it looks like in the mind of a professional speculator, why it's completely different from what you've been taught, and how to build it inside yourself, not through motivation, not through discipline, through understanding. Because once you truly understand how consistency works, you can't go back to trading the old way even if you tried. Let me take you back to 1907. I just made a fortune shorting the market before the panic. Papers called me the boy plunger. Everyone wanted to know my secret system. Truth is, I didn't have one, not the kind they meant. I'd been sitting on my hands for 3 months before that crash. 3 months. Do you understand what that means? Every day, watching prices drift higher, listening to men brag about their winnings, feeling like I was missing the greatest bull market in history. My broker thought I'd gone soft. My friends thought I'd lost my nerve. But I hadn't lost anything. I'd gained something. The ability to read what the market was really saying underneath all the noise. Prices were rising, yes, but they were rising wrong. The character of the movement had changed. Distribution masquerading as strength. I couldn't prove it with numbers. I just knew it the same way, you know, when someone's lying to your face, something in the voice doesn't match the words. So I waited, and waiting nearly killed me. Not because of the market, because of me. Every morning I'd promise myself, today, I stay out. And every afternoon I'd find myself at the brokerage, hand trembling as I almost placed orders I knew were wrong. The temptation wasn't to make a good trade, it was to make any trade. Just to stop the feeling that I was wasting time, missing opportunity, being left behind. This is what consistency actually costs. Not money, comfort. The ability to endure success that hasn't happened yet while everyone else is getting rich on what you know is an illusion. When that market finally collapsed, I made more in 2 weeks than most men make in a lifetime. But I'd paid for it in 3 months of psychological torture. 3 months of second-guessing myself, of wondering if I was wrong, of watching other men pile into stocks at the top while I sat there doing nothing. That's the part nobody tells you about. They tell you to be patient. They tell you to wait for your setup. But they don't tell you what it feels like to wait. They don't tell you about the voice in your head that says you're a coward, you're missing it, you're wasting your edge. I want you to really feel this with me. Imagine you've been studying the market for months. You've developed a read on what's happening. Everything inside you says danger is coming, but prices keep going up every single day. And every single day, someone you know is making money. They're buying new things. They're talking about their wins. They're looking at you like you're the fool. How long can you hold that position? How long can you trust yourself when the entire world is telling you you're wrong? Most men break within days. I've seen it 1,000 times. They develop a thesis, they wait for maybe a week, and then the pressure becomes unbearable. So they abandon their read and chase the move, and that's usually the exact moment the market turns. It's like the market was waiting for them specifically to give up before it proved them right. I'm not saying the market is conscious. I'm saying your inability to wait creates a pattern, and that pattern makes you predictable. And being predictable in this game means being broke. Think of the professional hunter tracking a tiger through the jungle. He can see signs everywhere: broken branches, fresh prints, the smell of the animal in the humid air. He knows the tiger is close. Every instinct screams to move faster, push forward, close the gap. But he doesn't. He stays absolutely still, sometimes for hours, because he understands something the amateur doesn't. The tiger is also hunting him. The moment he moves with impatience, with need, with emotional urgency, the tiger hears it, feels it, and vanishes. The market is exactly like this. It responds to your emotional state, even though that seems impossible. Not mystically, mechanically. When you trade from need, from fear of missing out, from hope instead of observation, you place orders at the wrong prices. You enter at exhaustion points. You exit at reversal points. Your desperation creates patterns, and the market, which is just the collective behavior of millions of desperate people, moves against those patterns automatically. The consistent trader isn't the one who shoots at every shadow. He's the one who can sit in the jungle, completely still, completely comfortable with inaction, until the exact moment when movement becomes inevitable. And then he moves once, decisively, and the hunt is over. Most traders are thrashing through the jungle, making noise, wondering why they never see the tiger. I'm telling you, the tiger sees you. Your job is to become invisible, which means becoming so patient, so devoid of need, that you disappear from the market's awareness until the moment you strike. Now you're starting to see it, aren't you? Consistency isn't what you thought. It's not about showing up every day to trade. It's about showing up every day ready not to trade until conditions meet your requirements. But that raises a harder question. What exactly are you waiting for? And how do you know when the wait is over? Let me break this down for you, because this is where most traders get lost. They understand patience in theory, but they don't understand what they're being patient for. You think you have a discipline problem. You don't. You have an identity problem. Every time you break your rules, you're not failing at discipline. You're succeeding at being who you actually are. The trader who can't stop overtrading isn't weak-willed. He's consistent, perfectly consistent with his actual identity. Someone who trades to feel something, not to make money. Here's what I learned the hard way. You cannot behave in ways that contradict your self-concept for very long. Doesn't matter how strong your willpower is. Your nervous system will find a way to pull you back to who you think you are. When I was young, I thought I was a genius trader. So every time I lost money, my identity was threatened. I couldn't accept losses because accepting them would mean accepting I wasn't a genius. So I held losing positions, averaged down, turned small losses into disasters, all to protect my self-concept. I wasn't trying to make money anymore. I was trying to prove I was right. That's a very expensive thing to prove. I lost my first fortune doing exactly that. Made $250,000 by the time I was 21. Lost every penny of it by 22. Not because I didn't know how to trade, because I didn't know who I was. The shift happened when I stopped identifying as a genius and started identifying as a student of speculation. Students are supposed to get things wrong. Students learn from mistakes. Once I made that shift internally, losses stopped threatening me. They became information. And suddenly, I could take small losses easily because they didn't contradict who I was anymore. See, when you identify as someone who's supposed to be right all the time, every loss is an existential crisis. But when you identify as someone who's learning the patterns of human behavior as expressed through price, losses are just tuition. You're paying to learn. That reframe changed everything. You want to be consistent? Change who you think you are. Don't try to be a disciplined version of your current self. Become a different self entirely, one for whom patience, observation, and selective action feel natural, not forced. I'm not talking about affirmations or positive thinking. I'm talking about a fundamental shift in how you see yourself in relation to this market. Are you a gambler trying to get lucky? Are you a genius trying to prove how smart you are? Are you a victim trying to get revenge on a market that hurt you? Or are you a student of speculation, someone who observes, learns, and acts only when the lesson is clear? That identity determines everything. It determines what you see when you look at a chart. It determines what you feel when a trade goes against you. It determines whether you can sit still for 3 months or whether you'll break after 3 days. And here's the thing that nobody tells you. You can't fake this. You can't pretend to be a patient trader while internally you're still a gambler. Your true identity will leak out through your behavior every single time. The market will find it, and it will take your money. So how do you change your identity? Not overnight, I'll tell you that. It took me years, multiple cycles of success and failure, but it starts with honesty. Brutal, uncomfortable honesty about who you actually are right now, not who you want to be, not who you tell people you are, who your behavior says you are. If you overtrade, you're someone who needs action to feel alive. If you take profits too early, you're someone who doesn't trust good fortune. If you hold losers, you're someone who can't admit being wrong. These aren't judgments, they're observations, and you can't change what you won't acknowledge. Write it down. What kind of trader does your behavior say you are? Then write down what kind of trader you'd need to become for consistency to feel natural. Look at the gap. That gap is your work, not on your strategy, on yourself. Every day before you look at charts, read both descriptions. Ask yourself, which identity am I operating from right now? If it's the old one, don't trade. Just observe. You're not ready yet, not because you're not skilled enough, but because you're not being the right person yet. This sounds soft, doesn't it? It sounds like psychology fluff. But I'm telling you, this is the hardest work in trading. It's easier to learn technical analysis. It's easier to backtest strategies. It's easier to manage risk. All of that is mechanical. This is personal. This requires you to look at parts of yourself you'd rather ignore. The part that's afraid. The part that needs to be right. The part that can't stand to miss out. The part that trades to feel something instead of to make something. Those parts don't go away because you learned a new indicator. They go away when you become someone different. Now let's talk about the two kinds of consistency, because this is where everyone gets confused. Everyone talks about being consistent with your system. That's amateur thinking. There are two kinds of consistency in this game, and only one makes you money. First kind, mechanical consistency. Following your rules, executing your setups, managing your risk the same way every time. This is what everyone teaches. This is what doesn't work, at least not by itself. Why? Because markets change. A system that works in trending conditions fails in choppy conditions. Rules that protect you in calm markets kill you in volatile markets. If you're mechanically consistent with a system, you'll be consistently wrong whenever market conditions shift. I changed strategies dozens of times across my career. Sometimes I was buying breakouts. Sometimes I was shorting weakness. Sometimes I was playing for quick turns. Sometimes I was holding positions for months. The strategy changed based on what the market was doing, but my psychology stayed consistent. I only traded when the situation was clear to me. I protected capital above all else. I let winners run until they told me they were done. I never argued with the tape. That's the second kind of consistency. Psychological consistency. You're consistent with your relationship to the market, regardless of conditions. You're always observing, always asking what is the market really doing, always willing to step aside when you don't know, always able to act decisively when you do know. The amateur thinks, I must follow my system no matter what. The professional thinks, I must follow the market no matter what, and adjust everything else accordingly. You're trying to be consistent with your plan. I'm telling you to be consistent with reality. Big difference. Your plan is something you made up sitting at home looking at historical charts. Reality is what's happening right now in real time with real money moving. Which one do you think matters more? Here's what this looks like in practice. Let's say you're a breakout trader. You've got rules for entries, stops, targets. You've backtested it. It works. Then the market shifts. Volatility expands. Breakouts start failing. Most traders keep following their system because that's what consistency means to them. They take loss after loss, wondering when their edge will come back. The psychologically consistent trader sees what's happening and stops. Not forever, just until conditions shift back. He doesn't abandon his method. He recognizes that the market isn't offering his method right now. So he waits. He stays consistent with his core principle. Only trade when conditions favor your approach. That's not being inconsistent. That's being intelligent. The market doesn't care about your backtest. It doesn't care that your system worked for 6 months. It's doing something different now. And you have to see it, accept it, and adjust. Mechanical. Consistency without psychological flexibility is just stubbornness. And stubbornness is expensive. I learned that lesson more times than I want to remember. Made money for months with one approach, then kept using it after conditions changed, gave back everything I'd made and more. Not because the approach was bad, because I was being mechanically consistent instead of psychologically consistent. So which kind of consistency are you chasing? Are you trying to follow your system no matter what the market does? Or are you trying to follow the market no matter what your system says? One of these will make you money. The other will make you broke. Choose carefully. And here's the hard part. Psychological consistency requires constant awareness. You can't just set it and forget it. Mechanical consistency is easier in that sense. You follow your rules and you're done. But psychological consistency means you're always reading, always interpreting, always asking if your read is still valid. It's more work. It's also the only thing that survives changing conditions. Now let me tell you about the paradox of control, because this will mess with your head. The more control you try to exert over trading outcomes, the less consistent you'll become. You cannot control whether a trade wins or loses. You cannot control when the market will move. You cannot control how fast profit arrives or how long drawdowns last. These things are completely outside your power, but your ego can't accept that. So you do things that create the illusion of control. Overanalyzing, overtrading, adjusting stops, taking profits early, adding to losers. All of it feels like control. None of it is. It's just anxiety dressed up as activity. Real consistency comes from accepting what you can't control and focusing completely on what you can. And here's what you can control: whether you take the trade or not. That's it. That's your only power. Once I'm in a position, the market decides what happens. But I decide whether to take the position in the first place. That's where I'm consistent, in my selectivity. I don't try to control outcomes. I control entrances. I let the market control exits. This is the paradox. Give up control of results, and your results get better. Try to control results, and you lose control of everything. Think about this for a second. Every time you move your stop loss because the market is getting close to it, what are you doing? You're trying to control the outcome. You're saying, I don't want to lose on this trade, so I'll change the rules. But the market doesn't care what you want. It's going to do what it's going to do. And by moving your stop, you're just guaranteeing that when it does hit you, you'll lose more than you planned. You haven't gained control. You've lost it. Same thing. When you take profit early because you're afraid the market will reverse, you're trying to control the outcome. But in doing so, you're cutting off the possibility of a big win. You're limiting your upside to protect yourself from the pain of watching profit disappear. I understand the impulse. I felt it 10,000 times. You're watching a winner, you're up a nice amount, and the market ticks against you. Immediately your stomach tightens, your mind starts calculating, if I take profit now, I lock in this much. If I wait and it reverses, I might lose it all. So you exit, and then you watch the market continue in your original direction without you. Now you feel even worse. You had it right, but you didn't trust it. That's not a strategy problem. That's a control problem. You tried to control when the market would top, and you guessed wrong. Here's what I learned to do instead. I give the market control of the exit. I let it tell me when it's done. How? By watching the character of the movement. When a stock is really moving in your favor, it moves with power. Each push higher is decisive. Pullbacks are shallow and brief. Volume confirms the direction. You can feel it. Then, at some point, that changes. The pushes get weaker. The pullbacks get deeper. Volume dries up or shifts. The stock is telling you it's tired. That's when I exit. Not because I'm afraid of losing profit, because the market showed me the move is over. I didn't control when that happened. I observed when it happened. Big difference. Same thing with entries. I don't try to pick the perfect entry. I don't try to buy at the exact bottom or short at the exact top. That's control-seeking behavior. Instead, I wait until the market shows me it's ready to move. A stock breaks out of a range with volume and conviction. That's the market telling me it's ready. I don't need to control the entry. I need to observe the entry the market is offering me. Sometimes I miss the first leg of a move because I'm waiting for confirmation. That's fine. I'd rather miss the first 10% of a move and catch the next 50% than try to pick the bottom and catch nothing but losses. This is what consistency looks like when you let go of control. You're not trying to impose your will on the market. You're trying to see what the market is doing and align yourself with it. You're not pushing. You're flowing. And flowing feels very different from fighting. When you're fighting the market, trying to control outcomes, every day is exhausting. You end each session drained, frustrated, second-guessing everything. When you're flowing with the market, observing and acting based on what you see, trading becomes almost effortless. Not easy. Effortless. There's a difference. Easy means no work. Effortless means the work is aligned with reality instead of opposed to it. Now I need to tell you why you keep breaking your rules. Because this is where it all comes together. You don't break your rules because you lack discipline. You break them because they're the wrong rules. Let me explain. Most trading rules are designed to prevent losses. Stop losses, position sizing, risk, management. It's all about not losing money. Makes sense, right? Wrong. Rules designed to prevent losses trigger your survival instincts. Every time the market moves against you, every time you see profit evaporate, every time you're tempted to overtrade, your brain interprets that as danger. And when your brain senses danger, willpower doesn't work. You go into fight or flight. Rules go out the window. I stopped breaking rules when I changed what the rules were protecting. Instead of rules to prevent losses, I created rules to preserve opportunity. Big difference. For example, don't overtrade is a rule to prevent losses. It triggers resistance. But only trade when you'd be willing to bet 5 times your normal size, then bet your normal size, is a rule to preserve opportunity. It makes you excited to pass on marginal setups because you're saving your capital for the real ones. See the shift? Same outcome. You trade less. But one feels like restriction. The other feels like strategy. Your nervous system can't tell the difference between real danger and money danger, but it can tell the difference between scarcity thinking and abundance thinking. When your rules are framed around scarcity, around protecting what you have, around not losing, your brain resists them. It feels like you're operating from fear, and nobody likes operating from fear. We want to feel powerful, decisive, in control. So we break the rules that make us feel afraid. But when your rules are framed around abundance, around saving your power for the right moment, around making the big score when conditions are perfect, your brain embraces them. Now, you're not afraid. You're strategic. You're a hunter conserving energy for the kill. Frame your rules around what you're moving toward, not what you're running from. You'll stop breaking them. Instead of, I must cut losses quickly to avoid big drawdowns. Try, I protect my capital so I'm fully loaded when the big opportunity arrives. Instead of, I can't overtrade or I'll blow up my account. Try, I save my firepower for the trades where I have overwhelming conviction. Instead of, I have to follow my stop loss or I'll lose everything. Try, I honor my stop loss because it frees me to take the next trade without baggage. Every single one of these is saying the same thing, but the framing is completely different. And framing matters because your brain responds to framing. I'll give you a personal example. Early in my career, I had a rule: never let a winner turn into a loser. Sounds good, right? Cut losses, let winners run, never give back profit. But I kept breaking that rule. I'd be up on a position. It would pull back to break even, and I'd hold it hoping it would bounce. Then it would turn into a loss. and I'd be furious at myself for breaking my rule again. This happened over and over. I thought I had a discipline problem. Then I realized the rule was wrong. It was framed as prevention. Never let a winner turn into a loser. That's fear-based language. So I changed it. New rule. When a trade proves me right by moving into profit, I raise my stop to protect that validation. Same concept, different framing. Now I wasn't afraid of letting a winner turn into a loser. I was protecting the market's validation of my read. That shift made the rule easy to follow. I stopped breaking it because it stopped triggering my fear response. This is what I mean when I say your rules are probably wrong. Not wrong in terms of content, wrong in terms of framing. And wrong framing makes discipline impossible. You can't discipline yourself into following rules that trigger your survival instincts. You can only reframe the rules so they align with your natural drives instead of fighting them. Once you do that, consistency becomes automatic. You're not forcing yourself to do the right thing. You're naturally drawn to do the right thing because the rule appeals to something you want instead of something you fear. Let me give you the consistency equation, because this formula changed everything for me. Consistency equals clarity times conviction divided by need. Clarity, how well you understand what the market is actually doing right now, not what you hope it's doing, not what it should be doing, what it is doing. Conviction, your confidence in your read of the situation. This only comes from observation and experience, never from hope or fear. Need, your emotional requirement for this trade to work. The more you need the trade to win, need the money, need to be right, need to recover losses, the less consistent you'll be. The equation explains everything. You can have perfect clarity and strong conviction, but if your need is high, consistency drops to zero. You'll exit winners too early because you need to lock in profit. You'll hold losers too long because you need to be proven right. Most traders try to increase consistency by improving clarity, more analysis, better indicators, more screen time. That's only 1/3 of the equation. If you don't address need, all that clarity is wasted. How do you reduce need? Simple but not easy. Only risk money you can afford to lose. Never trade to solve financial problems, and separate your self-worth from your trading results. Do those three things, and need drops towards zero. When need is zero, clarity and conviction are enough. That's when you become consistent. Let me tell you what need looks like in real trading. You've had a bad month. You're down 20%. Your account is hurting. Your confidence is shaken. Now a setup appears. It's decent. Not great, but decent. Normally you might pass on it. But this month you need a win. You need to recover those losses. You need to prove to yourself you haven't lost your edge. So you take the trade. And because you need it to work, you manage it wrong. You don't follow your stop because you can't afford another loss. You take profit too early because you desperately need to book a winner. The trade might have worked if you'd managed it properly, but you didn't. Your need destroyed your execution. That's the equation in action. Your clarity might have been decent. Your conviction might have been sufficient, but your need was through the roof, and need is in the denominator. High need makes the whole equation collapse. Now contrast that with a different scenario. You've had a great month. You're up 30%. Your confidence is high. You're not thinking about money anymore. You're in flow. The same setup appears. Decent, not great. This time you look at it and think, not good enough. I'll wait for something better. You pass. Why? Because your need is low. You don't need this trade. You don't need to make money today. You can afford to wait. So you're more selective. Your threshold for entry is higher. And paradoxically, that makes you more consistent. You take fewer trades, but the ones you take have higher quality. That's what low need creates. This is why trading with money you can't afford to lose is suicide. It's not just that you might lose it, though that's bad enough. It's that needing the money makes you incapable of trading well. You can't be selective when you need to make money today. You can't let winners run when you desperately need to lock in profit. You can't take losses quickly when every loss feels like a catastrophe. Need corrupts everything. It turns good traders into bad traders. I've seen men with great market instincts blow up their accounts over and over because they were always trading with scared money. Money they needed for rent, for bills, for their families. That need made it impossible for them to execute properly. They knew what to do. They just couldn't do it because the pressure was too high. So here's what you need to understand. Before you work on your strategy, before you work on your discipline, before you work on anything else, you need to work on your need. You need to get to a place where trading results don't determine your survival or your self-worth. That might mean trading smaller. It might mean getting a job to cover your expenses. It might mean stepping away from trading entirely until you've saved enough capital that you can afford to lose what you're risking. I know that's not what you want to hear. You want to hear about the strategy that will make you consistent. But I'm telling you, no strategy can overcome high need. The equation doesn't allow it. Need will destroy you no matter how good your analysis is. This is why I always say, trade with risk capital only. Money that if you lost every penny, your life wouldn't change. You'd be disappointed, sure, but not devastated, not desperate. When you trade with risk capital, need drops to nearly zero, and suddenly, consistency becomes possible. You can wait for the right setups. You can let winners run. You can take losses without spiraling, not because you've become more disciplined, because you've removed the pressure that made discipline impossible. That's the real secret. It's not about getting better at handling pressure. It's about removing the pressure in the first place. Now let me show you what consistency looks like in practice, because understanding it conceptually and actually building it are different things. First thing you need to do is an identity audit. Sit down with a pen and paper, not your phone. Paper. Write down your answer to this question. What kind of trader do I believe I am right now? Be brutally honest. Don't write what you want to be. Write what your behavior says you are. If you overtrade, maybe you're a trader who needs action to feel alive. If you take profits too early, maybe you're a trader who doesn't trust good fortune. If you hold losers, maybe you're a trader who can't admit being wrong. These aren't judgments. They're observations. Now write a second answer. What kind of trader would I need to become for consistency to feel natural? Look at the gap between those two answers. That gap is your work, not on your strategy, on yourself. Every day for the next 2 weeks, before you look at charts, read both answers out loud. Then ask yourself, which identity am I operating from right now? If it's the old one, don't trade. Just observe. You're not ready yet, not because you're not skilled enough, but because you're not being the right person yet. This sounds soft. It's not. It's the hardest work in trading, but it's the only work that actually changes anything. Most traders skip this step. They want to jump straight to strategy and execution. But you can't execute consistently if you're operating from the wrong identity. It's like trying to run a marathon when you still think of yourself as someone who hates exercise. Your identity will sabotage you every time. You have to change the identity first. Then the behavior follows naturally. I spent years trying to force myself to be disciplined before I realized the problem wasn't my discipline. It was my identity. Once I shifted from seeing myself as a genius who should always be right to seeing myself as a student who's learning patterns, everything changed. The same behaviors that felt impossible before became natural. Not easy. Natural. There's a difference. Second thing, start keeping a clarity journal. Stop keeping a traditional trading journal. Those don't work for most people because they focus on outcomes. What you did, what happened, how much you made or lost. Instead, keep a clarity journal. Every day, market open to market close, answer these 3 questions. 1. What is the market actually doing today? Describe behavior, not direction. Is it trending, chopping, expanding, contracting? 2. How clear is this to me? Rate 1 to 10. Be honest. 3. If my clarity is below 7, why am I even considering trading? That's it. 3 questions. The goal isn't to trade more. It's to build your ability to recognize when you have real clarity versus when you're just hoping you do. After a month, you'll notice something. Your clarity scores improve, and your temptation to trade on low clarity days vanishes. Not because you're more disciplined, because you've trained yourself to recognize the difference between knowing and guessing. Once you feel that difference in your body, consistency becomes automatic. You stop taking trades when you're guessing because guessing feels different from knowing, and you can't unfeel that difference once you've learned to recognize it. I'll tell you exactly when I learned this. I was about 25 years old. I'd been trading for years by that point. I thought I knew what I was doing. Then I went through a period where nothing worked. Every trade lost. I couldn't figure it out. I was following my rules, taking good setups, but the market was just grinding me down. Finally, out of frustration, I stopped trading completely for 2 weeks. Just watched. And during those 2 weeks, something shifted. I started to notice the difference between times when the market was clear and times when it was ambiguous. When it was clear, I could see what it was trying to do. The direction, the strength, the character of the move. It was obvious. When it was ambiguous, I was just projecting what I wanted to see onto random movement. The revelation was this. I'd been trading both conditions the same way. I didn't distinguish between clarity and confusion. I just took my setups whenever they appeared. No wonder I was losing. Half the time I was trading in conditions where nothing was clear. So I made a new rule. I only trade when I can clearly see what the market is doing and where it's likely to go next. If I can't see that, I don't trade. Sounds simple. It changed everything. My win rate jumped. My confidence soared. Not because I got better at analysis, because I stopped trading when I was guessing. That's what the Clarity Journal does for you. It teaches you to recognize the difference. And once you can recognize it, you can't ignore it. Your brain won't let you trade when you're guessing anymore because it knows that's not real opportunity. Third practice, the waiting drill. Here's the assignment. For 1 full week, do not place a single trade. I don't care if the perfect setup appears. I don't care if you're missing the move of the year. You're not trading. Instead, your job is to watch yourself wanting to trade. Observe your own mind. Notice when the urge appears. Notice what triggers it. Notice how it feels in your body. Notice what stories you tell yourself to justify taking action. Write down every time you would have traded and why. Then write what you were really feeling in that moment. Not the trading reason, the emotional reason. Were you bored, anxious, excited, trying to prove something? This week will teach you more about consistency than a year of actual trading, because you'll see the pattern. You don't trade for the reasons you think. You trade to manage your emotional state. And once you see that clearly, once you catch yourself doing it, you can start to interrupt the pattern. The goal isn't to never feel those emotions. The goal is to stop letting them pull the trigger. I did this exercise myself multiple times across my career. Every time I went through a rough patch, I'd stop trading for a week and just observe. And every single time, I discovered something about my behavior I hadn't seen before. Some emotional pattern, some trigger, some story I was telling myself that was causing me to trade poorly. You can't see these patterns while you're in the middle of trading. You have to step back and watch yourself from outside. Most traders resist this exercise. They say they can't afford to miss a week of trading. What if the market moves without them? What if they miss opportunities? I always tell them, you're already missing opportunities. You're missing them by taking bad trades. Taking a week off to understand why you take bad trades is the best investment you can make. It's paying tuition to learn about yourself. And learning about yourself is more valuable than any strategy or indicator, because yourself is the constant. Strategies change, markets change, but you're always there. If you don't understand how you operate, you'll keep making the same mistakes no matter what strategy you use. Fourth practice, the single focus rule. For the next month, you're only allowed to look for one type of setup, just one. I don't care what it is. Breakouts, pullbacks, reversals, whatever. Pick the one that makes the most sense to you and ignore everything else. This sounds limiting. It's liberating. Here's why. Most inconsistency comes from trying to be good at everything. You're a breakout trader on Monday, a mean reversion trader on Tuesday, a scalper on Wednesday. You're not building expertise. You're building confusion. Consistency requires depth, not breadth. A master of one pattern will always beat a dabbler in 10 patterns. Always. When you focus on one setup for a month, 3 things happen. First, you start seeing it everywhere. Your pattern recognition gets sharp. Second, you learn its failure modes, when it looks right but isn't. Third, you build conviction. You stop second guessing because you know this pattern. I learned this lesson painfully. When I was young, I wanted to catch every move. If stocks were breaking out, I was buying breakouts. If they were pulling back, I was buying pullbacks. If they were topping, I was shorting. I thought I was being flexible. I was actually being scattered. I never developed deep expertise in any one approach, so I was always a little uncertain, a little hesitant, and that uncertainty leaked into my execution. Then I went through a period where I only played one setup, buying stocks breaking out of consolidation patterns with increasing volume. That's it. For months, that's all I looked for. And something amazing happened. I got so good at spotting that pattern that I could see it developing days before the breakout occurred. I could feel when a stock was coiling, ready to move. My timing got sharper. My conviction got stronger. My results improved dramatically, not because the pattern was magical, because I'd developed mastery of it. I wasn't guessing anymore. I was recognizing. And recognition is so much more powerful than analysis. After a few months, I added a second pattern, then a third, but I built them one at a time, going deep before going wide. That's how you build real consistency. You don't need to know how to trade every condition. You need to know how to trade one or two conditions extremely well, and how to recognize when those conditions aren't present so you can step aside. That's the whole game. Deep expertise in a few patterns, and the wisdom to wait when those patterns aren't available. Most traders have it backwards. They know a little about a lot of patterns and can never decide which one to trade, so they chase everything and master nothing. Fifth practice, the need elimination test. Here's how you know if need is destroying your consistency. Ask yourself before every trade, would I take this same trade if I'd already made $10,000 this week? If the answer is no, then you're trading from need, not from opportunity. Don't take the trade. Would you take it if you'd already lost $10,000 this week? If the answer is no, you're trading from need, either needing to recover or needing to protect what's left. The consistent trader takes the same trades whether he's up or down. The inconsistent trader changes his behavior based on his profit and loss. That's the tell. For the next month, before every trade, ask those two questions. If either answer is no, pass. You're not being consistent. You're being emotional. And emotional trading looks like activity, but it's really just expensive therapy. I can't tell you how many times I've seen traders go on tilt after a big loss. They start taking wild trades, trying to make back what they lost, or they freeze up after a big win, afraid to give back their profits. Both are forms of need. The loss created a need to recover. The win created a need to protect. And need makes you incapable of trading well. The solution isn't to not care about your results. It's to care about them in a different way. Instead of caring about each individual trade, care about your long-term process. Am I trading when I have clarity? Am I following my rules? Am I learning from my mistakes? Those things you can control. The outcome of any single trade you cannot. So why let it affect your decision-making? I know it's hard. Money is emotional. Losing hurts. Winning feels good. But if you let those feelings dictate your behavior, you'll never be consistent. You'll always be reacting to your last trade instead of responding to current conditions. Here's a mental trick I used. After every trading session, I'd write down my profit or loss for the day. Then I'd close the journal and forget about it. The next morning, before I looked at charts, I'd ask myself, what would I be looking for today if I had no idea what happened yesterday? What's the market actually doing right now? That question forced me to approach each day fresh, without the baggage of previous results. It helped me reduce need, because I wasn't trading to recover from yesterday or protect yesterday's gains. I was just trading today's opportunity, whatever that was. Try it. It's harder than it sounds. Your brain wants to anchor to recent results, but consistency requires you to let that go. So now we've covered the structure of consistency: identity over behavior, psychological consistency over mechanical consistency, clarity times conviction divided by need. Control what you can control and release what you can't. Frame your rules toward opportunity instead of away from fear. These aren't tactics. These are principles. And principles work in any market, any condition, any time frame. But principles only help if you actually implement them. And implementation is where most traders fail. Not because they don't understand, because they don't commit. Let me tell you what commitment actually means. It doesn't mean you're motivated. Motivation is temporary. It doesn't mean you're excited. Excitement fades. Commitment means you keep doing the work, even when you don't feel like it, even when it's not working yet, even when you can't see progress. That's the difference between traders who eventually become consistent and traders who keep starting over every few months. The consistent ones committed to the process and trusted it would work if they gave it enough time. The inconsistent ones kept looking for shortcuts, kept switching approaches, kept hoping they'd find the magic solution that wouldn't require real work. There is no magic solution. There's only the work of becoming someone different, the work of training yourself to see clearly instead of projecting your hopes onto randomness, the work of sitting still when your whole body wants to move, the work of moving decisively when your fear wants you to hesitate. That work is hard. That work is uncomfortable. That work requires you to confront parts of yourself you'd rather ignore. But that work is the only thing that creates real, lasting consistency. Everything else is just temporary improvement that evaporates under pressure. I'm not going to lie to you and tell you it's easy. I'm not going to promise you that if you just follow these steps, you'll be consistent in 30 days. It took me years, multiple cycles of success and failure, fortunes made and lost. But every cycle taught me something. Every failure revealed a weakness I didn't know I had. Every success showed me what was possible when I got it right. And gradually, over time, the gap between my best trading and my worst trading narrowed. I still had losing periods, but I stopped having catastrophic periods. I stopped blowing up. I stopped going on tilt. I stopped letting emotions override my judgment. That's what consistency looks like. Not perfection, not constant winning, just a tighter distribution of outcomes. Because you're operating from a stable foundation instead of shifting sand, you're probably wondering, how long will this take for me? I can't answer that. It depends on how honest you're willing to be with yourself. It depends on how much you're willing to let go of who you think you are to become who you need to be. It depends on whether you're trading to make money or trading to be right or trading to feel something. Those are different games with different paths to mastery. But I can tell you this, it takes as long as it takes, and trying to rush it only makes it take longer, because rushing is need, and need is the enemy of consistency. So here's what I want you to do after you finish watching this. Don't immediately go look at charts. Don't immediately start planning your next trade. Sit with what you've learned for a minute. Ask yourself, which of these ideas hit me the hardest? Which one made me uncomfortable? Whatever that is, that's where your work is. That's the thing you've been avoiding. That's the identity pattern or the need pattern or the control pattern that's been sabotaging you. You felt it when I said it. You know what it is. Now you have to decide, am I going to keep avoiding it, or am I going to do the uncomfortable work of changing it? Most people will avoid it. They'll acknowledge the insight, they'll agree it's true, and then they'll go right back to trading the same way they always have. Because change is hard. Because it requires you to admit you were wrong about something fundamental. Because it means letting go of patterns that feel like part of your identity. I understand. I've been there. But I'm telling you, if you don't change, nothing changes. You'll still be having this same conversation with yourself in a year, still wondering why you can't be consistent, still knowing what to do but not doing it, still stuck in the gap between who you are and who you need to be. Or you can make a different choice. You can commit to the work. You can start the identity audit tonight. You can begin the clarity journal tomorrow. You can take a week off to observe yourself. You can pick one setup and go deep on it for a month. You can start testing yourself for need before every trade. These aren't big things. They're small practices. But done consistently, they reshape how you think about trading, how you think about yourself, and how you show up to the market. And when those things change, consistency stops being something you chase and starts being something you embody. I want to be very clear about something. This isn't a mindset hack. This isn't positive thinking. This isn't about repeating affirmations or visualizing success. Those things might make you feel better temporarily, but they don't create lasting change. What creates lasting change is understanding the actual mechanics of consistency, seeing where you're out of alignment, and doing the specific work to fix it. It's not motivational, it's mechanical. Cause and effect. If you change your identity, your behavior changes. If you reduce need, your execution improves. If you focus on clarity instead of conviction without clarity, your selectivity improves. These are laws, not suggestions. And that's actually good news, because laws are reliable. If you do the cause, you get the effect. It might take time, it might be uncomfortable, but it works. I've seen it work in myself. I've seen it work in the few traders I've known who went from inconsistent to consistent. They all went through the same process. They all had to confront the same things. And they all came out the other side as different people. People for whom consistency was natural instead of forced. That's what's waiting for you on the other side of this work. Not perfection, not constant winning. Just a way of operating that feels aligned instead of conflicted, that feels clear instead of confused, that feels calm instead of chaotic. You know what the most interesting thing is? Once you become consistent, trading gets boring. That sounds bad, but it's actually the goal. When trading is exciting, it means you're gambling. You're taking risks you shouldn't take. You're hoping for outcomes you can't control. You're on an emotional roller coaster. When trading is boring, it means you're only trading when conditions are clear. You're managing positions mechanically. You're letting the market do the work while you watch patiently. Boring is profitable. Exciting is expensive. Most traders don't want to hear that because they got into trading for excitement. But if you want consistency, you have to let go of the excitement and embrace the boredom. I remember the shift vividly. I'd been trading for about 10 years at that point. I'd made money, lost money, made it back, lost it again, always on the roller coaster. Then something changed. I started trading in a way that felt almost mechanical. Wait for clarity, enter when conditions are right, let the position work, exit when the market tells me to. No drama, no excitement, no anxiety, just observation and execution. And I remember thinking, this is boring. I'm not feeling anything. And then I realized, that's the point. That's what consistency feels like. It feels like nothing. Like you're barely doing anything. Like you're just watching the market and occasionally pressing a button. But that nothing generates profits because you're not fighting anymore. You're flowing. If you're still chasing the excitement, if you're still getting an adrenaline rush from trading, you're not consistent yet. You're still gambling. And that's fine. Everyone starts there. But at some point you have to decide, do I want excitement or do I want consistency? Because you can't have both. Exciting. Trading is inconsistent by definition. Consistent trading is boring by necessity. Which do you want? Really think about that, because your answer determines everything. If you want excitement, go to a casino. It's cheaper and more honest. If you want consistency, embrace the boredom and do the work to get there. Let me bring this home for you. Everything I've told you today comes down to one fundamental truth. Consistency is not about what you do. It's about who you are. And who you are is not fixed. You can change it. But you have to do it consciously, deliberately, through practices that reshape your identity and your relationship to this market. You can't think your way to consistency. You can't analyze your way to consistency. You have to become your way to consistency. That's the work. That's the only work that matters. So here we are, 50 minutes later, and you're starting to see it now, aren't you? Consistency was never about what you thought it was. It wasn't about discipline or systems or finding the perfect strategy. It was about becoming a different person. Someone who can sit still in chaos, who can wait without anxiety, who can act without need. You've been fighting the wrong battle, trying to force yourself to follow rules that contradict who you actually are, trying to be consistent with behaviors that don't match your identity, trying to control things you have no power over while ignoring the one thing you can control, who you become in relationship to this market. Here's what changes from this moment forward. You stop trying to be a disciplined trader and start becoming an observant one. You stop trying to control outcomes and start controlling your selectivity. You stop breaking rules because you design rules that align with who you're becoming, not who you were. Consistency isn't something you achieve through effort. It's something that emerges when you finally align your identity, your psychology, and your behavior with how markets for session actually work. You're not broken. You've just been misled, told that consistency is about showing up every day to trade, when really, it's about showing up every day, prepared not to trade, unless everything aligns. Let me leave you with this. The market doesn't reward the busiest trader. It rewards the most patient one, the most consistent one. the one who can wait without suffering, act without hesitation, and lose without breaking. That trader isn't born. He's built, one decision at a time, one identity shift at a time, one moment of clarity at a time. That's the work. Now you know what it is. If this resonated with you, if you felt something shift while watching this, then I need you to do something for me. Hit that like button. Not because it helps the algorithm, but because it tells me you're serious about this transformation. Leave a comment with one thing you're going to change after watching this. And subscribe if you want more of this truth, the kind that doesn't come from textbooks or trading courses, but from 40 years of actually doing this work, making the mistakes, learning the lessons, and paying the real cost of real consistency. I'll see you in the next one.